Okay. Anything you want to add outside the pricing to the bars?
Sure. So there's one thing to also mention is everything we do is wholly allocated. So unlike almost every other physical gold store place, storage place you see online, where you're buying a piece of a pool of gold, where they call it it's allocated because there's gold behind it. With us, you're actually buying whole gold bars. So if you say I want 10 ounces, traditionally they're saying, okay, you own 10 ounces of gold in London or Zurich, but you don't actually own a bar or something that's actually yours.
Mm-hmm.
Because we're so obsessed with removing counterparty risk, we actually allocate clients whole gold bars. So that if our firm ever goes bankrupt or we're gone, that they can say that okay, that gold bar is yours. One of the things we always wonder is the traditional gold trading sites you see online, clients are buying a piece of a larger gold bar. So I always wonder what happens if that firm goes bankrupt. How do you determine who owns that gold bar? Who pays the cost of splitting up that gold bar and giving everybody their money back?
You fight over it.
Right.
What else, right?
Right. It creates an enormous amount of confusion. And so what we were doing is by creating this dealer network, we're able to service clients who want 10 ounces. You can say, sure, you can have 10 ounces of allocated whole bars in a vault location of your choice, which they could never get before the solution came in. That's usually something limited to the ultra high net worth, not even the high net worth, but the ultra high net worth of society.
Mm-hmm.
And we're trying to democratize that down to everybody.
Okay, I asked earlier, are you familiar with Eric Sprott and his physical
Yep.
trust?
Very well.
Compare and contrast.
So it's a bit different. So Eric's, or PHYS, the ticker,
Mm-hmm.
trades on the stock exchange. So there's counterparty risk in having anything on a stock exchange. When you're buying shares of a trust.
Before you go forward,
Sure.
What is a counterparty for those who either may not understand or may not agree? Expound.
Of what the counterparty is?
Counterparty risk by trading on a stock exchange.
Sure. So you're buying your shares through intermediaries. So
Mm-hmm.
it's not you. You're not coming directly and buying your asset. You're buying first a share from a broker who then is purchasing it off the floor of an exchange or now through an electronic means. So you've added 2 or 3 people between you and the actual stock certificate.
Mm-hmm.
And then to add that stock certificate is for a piece of ownership of a trust,
Mm-hmm.
not a piece of a gold bar. So when you're buying a closed-end fund or an ETF, you're not actually buying the physical asset. You're buying a piece of a trust that owns a bunch of gold,
Mm-hmm.
as opposed to what we do, where you're actually just buying a whole gold bar. So it's literally, you own this whole gold bar, or you own a piece of a trust that owns this piece of a gold bar. So there's a lot of separation between you and your asset. Now, what's unique and great about that fund is you have the ability to physically redeem your shares for the physical asset. So you can actually take your shares, give them to your financial advisor, push them back to DTCC, who's the clearing agent for shares, and then take a physical bar. The risk or the hole we see in that is it's an inefficient process. So the first thing is you can only redeem if you have 400 ounces of gold, which in today's prices is almost $800,000.
Mm-hmm.
So that eliminates almost everybody from taking physical delivery because that's just such a high number that if you're putting a 5 or 10% allocation, that's an enormous investment account to have.
Mm-hmm.
The second aspect is when you put in for physical delivery, you don't get the bars right away. You have to file forms, you have to remove the shares from the stock exchange. There's a 15, 30-day window, and so you lose flexibility. You lock in your price, but then you don't get your asset for another till delivery happens, which could be 15 days, 2 weeks, 3 weeks, 4 weeks. And so it's not an efficient process to get physical exposure. I think it's probably better than ETFs are out there because you have certainty that the asset is actually there, but it's not as good as actually owning the real asset. And so if we can create ownership of the real asset with the same liquidity and the same price, you should always choose that over having something on the stock exchange.
So, to be a stickler in semantics, the counterparty risk is not going through the exchange, but the construction of the trust itself.
It's both. So, what happens to the exchange? Who's record keeping all the shares?
Mm-hmm.
Who can claim ownership of actually having ownership of the trust? So there is some counterparty risk there.
Of course. Now, there's some, and let me be the devil's advocate. Are you asserting that the counterparty risk of the exchange is somehow higher than the counterparty risk of dealing with you directly?
Well, we don't think there's a counterparty risk with us because the gold's not in our name.
It's potential for fraud.
With our model?
Of course.
How so?
You send me, let's take something very simple.
Sure.
I send you money directly.
Yeah.
You say it's in XYZ vault. It's not.
Sure. Well, I think you have that risk if you buy your stock exchange through a regular broker dealer too.
Mm-hmm.
So that risk will always exist no matter what institution you work with.
Right.
The other risk you have when you work through an exchange is you have to buy it through an intermediary or broker dealer. You might be buying your shares through MF Global,
Mm-hmm.
who's then a member of that exchange, and so that definitionally are adding another counterparty because retail investors and high net worth investors can't deal directly with the exchange. You're dealing with someone in between.
Mm-hmm.
So I buy my shares through Scottrade. There's a counterparty risk of me giving my money to Scottrade to go buy those shares because what if they're gone the next day?
Mm-hmm. And you have the exchange provides fail-safes and for things such as brokerage firms going out of business.
Sure.
Am I correct?
Yeah, it's a process, right? It's not immediate.
Right. So and I'm simply playing devil's advocate.
Yeah, sure.
Okay. The fail-safes from your side are.
So the first thing is that we don't keep title in our name. So the big difference is when you have title in your name. So if you,
I mean, not outside of everything you've explained. I understand you've explained a decent amount, but outside of that,
outside of that, there's not a lot you need. So the big problem is if I buy my stock through a big Wall Street bank, I have an account at Morgan Stanley or Merrill Lynch or one of these places.
Mm-hmm.
The shares are in that firm's name.
right?
With us, the equivalent of shares is actually the bar. It's not in our name, so we can never take those assets out because we don't own them.
Okay.
So that's our biggest protection.
Okay. Do you do any advisory at all?
No.
Commentary, opinion?
We comment on macroeconomy. We speak at some conferences and universities, but we don't advise clients. We want to be more the platform than the advisory.
Okay. The commentary. Give me an example of.
We often are asked, what's your thesis on gold or why do you believe in gold, and I can give our thoughts on that. So, and I'm speaking more for myself and the firm, but I guess it's probably become a bit of what the firm believes too now is.
Okay. Just